It is exactly that. It's single family homes. It's residential real estate, homes on land in desirable areas. Because of the scarcity of the actual product itself in these cities, those property values are going to continue to grow, especially as they're not being built and the plots of land keep getting smaller. And welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. Well, unless you've been completely not paying attention to what's going on economically speaking in the United States and Canada, we are going down the pipe, I'd say quickly, relatively quickly. Some economists would agree, some would not. But along with that comes the benefit of inflation coming in less hot than it has been, and unfortunately losing jobs and lower wages. It comes with one big upside, and that big upside is interest rate declines. So the question that people are asking right now is, well, how fast do rates keep coming down? And over what period of time? And for what reason will they continue going down, and why? Like, how do I pick a mortgage product today in this type of environment? And that's a question I literally have to answer every single day, every day right now. Even the people who got their mortgage 2 months ago that are funding in a month, people who closed on the mortgage a couple months ago are asking the question, did I take the right product? Well, I think a few questions you always have to ask yourself before I get into what's happening and how to make a decision in this current rate environment is, first and foremost, are you making the best decision for your situation at that time with all of the information intact, or are you just going to default to what is the lowest possible solution at that given time? And if you can answer that question, you'll have a better understanding as to whether or not you're making the right decision. To put that in context in English, in a different language, I think what happens is a lot of people, they default to what they hear or the information at that time and what they're afraid of, and they make a decision based on either fear or hype, as opposed to assessing it on a regular basis and understanding that things can change and knowing that there are upsides in other options. So, case in point, taking the most common mortgage product for the last 4 months in Canada, which is the 3-year mixed mortgage product, could be the biggest mistake that someone could be making or may have made in the last little while. And here's the crazy thing. It wasn't the wrong choice for a number of months up until, just recently. So the question begs is, how do I make that, and how do I pivot on that so quickly, and why do things happen so quickly? Well, data is the reason that these things can happen. We've had a pretty stubborn few months now when it comes to inflation, although if you've been following along over the course of the summer, things have been on a downward trend, and we've seen the downward trend of not just interest rates but inflation coming in lower and lower and lower every single time, which to the average Canadian consumer doesn't necessarily feel the case because values obviously go up when inflation is still above zero. For the sake of conversation, it is having an impact on the marketplace, and things are happening faster and more swiftly than maybe some originally anticipated, especially those back in that April, May market when all of a sudden fixed rates were going up. So what are we getting to here today, and where are things going in the future? Let's talk a little bit about trends right now and what's going on. So, unless you've been hiding under a rock, you know that the July headline for the CPI index, and I know this is some old news when this comes out, but for anybody not paying attention, they came in and decreased a 2.5% year over year pace, which is, I believe, the lowest drop since February of 2021. So, the lowest below the 10-year average since February 2021, to be more specific. The BOC itself dipped, so its favorite measure itself dipped to 2.55%, which is low and lower than it was. And more importantly, it changed the sentiment in the markets. And the markets all of a sudden suggested really quickly and unsurprisingly that they supported nearly 100%, 98% to be specific, percent chance of the BOC cutting rates for a third consecutive cycle by another quarter point. Now, I've heard some people out there suggest that we could see the BOC cut rates 0.5% in September. I think that's unfounded, and the market agrees with that statement. The statement of the markets is that there's like a 8% chance of that happening, and even that seems a little bit high, to be honest with you. A quarter point chance, a quarter point rate drop, which is basically baked in by every single bank at this point right now, and virtually every single economist that you talk to, seems to be more tangible based on what's going on, and with more data coming up, but not a significant amount before the September announcement. I think that's probably the most likely outcome. In fact, it's nearly a lock at this point, as I mentioned. So, conversationally speaking, like, what does that do to impact the marketplace is the big question. How do you take this information and make an educated decision on which type of mortgage product you want to do? And what does that mean for the general consumer? I mean, obvious statement here. Anybody who has a variable rate mortgage or a line of credit is rejoicing. They're jacked. They're pumped. They're sitting there saying, man, that quarter point. I know some people look at this and say, oh, it's just another point. Well, quarter point. Well, that means that over the course of the last 3 months, we saw quarter. So that's 75 basis point reduction. So it starts to add up as time goes on. So we feel a little bit, not necessarily less tightening of the wallets per se, because everything else is more expensive, but we feel a little bit of relief at this point. We're starting to see that relief, which leads to a conversation around, well, if we start to see the relief on the lines of credit, even minor, and we start to see a little bit of relief on the variable rate side of things, what does that mean overall? Does it continue? And what's the outlook in the real estate market? Now, I'm just pulling up a quick little report that I was looking at. And I don't know that this is the trend that will continue for 2024, but I think that it's probably not wrong to suggest that we may now have seen the bottom in some markets. Man, if you're watching this and you're saying, oh, we haven't seen the bottom of condos, yeah, okay, you're right. We probably haven't seen the bottom of condos in certain markets. Totally fair. But we're starting to see some markets start to quote unquote bottom out and rebound a little bit. And those markets specifically are the detached homes, so single family homes in that entry level price point in many different markets across the country. So if we did a survey of the top 10 markets across the country, 4 to 10 of those markets are actually seeing increasing detached housing values. Now, you might say the opposite, which is that 60% of the market has not seen an increase, but it is notable to suggest that that rebound is starting to happen in some markets. And then you have the outlier of Alberta, which has just stayed red hot throughout the entire summer. And I don't know when that train ends at this point right now, but for the sake of conversation, I think rates reducing will keep some people in their existing places and probably mean less people coming into Alberta. So we might see that train roll down. So looking at this article talking about house prices and points and what this could mean, the first half of 2024, investors and buyers drove detached home prices in Canada's priciest markets, including the GTA, GVA, and Fraser Valley, which was this market. It says, while affordability remains an obstacle for first-time buyers, more experience, meaning people have more equity, obviously, buyers and investors are taking advantage of the softer housing values. And I saw that to a degree, especially when it came to single-family homes. But what's interesting about this article, from my perspective, is that I saw a significant amount of first-time buyers this year, more so than I had in the past, and they were purchasing up like condos and things like that. But in the last few months, so the summer of 2024, I've actually seen a lot more people come back to the markets. This is obviously anecdotal from my perspective, and start to make that move up. Single family homes, a big load of my clients right now are not just buying, but they're moving up into different properties. So we're seeing a lot of purchases in today's market right now make that trade up because they've seen that the detached market has come down much more significantly than like a townhome or a condo. Anyways, just to trade off and continue back on my conversation about where rates are going and what's happening right now. So the rate forecasts. So September, if interest rates come down a quarter point, which is what is currently expected to happen at this time right now, so a quarter point reduction, then what we'll see here is $15 for every $100,000, which again, 15 plus 15 plus 15. So now we've got essentially $45 per 100 grand drop in the last few months in terms of total cost. And in addition to that, that's per 100,000. So over $500,000, you can do the math, that's over $200. So we're starting to see this actually impact people's sentiment, people's feelings towards the marketplace. So with that being said, one of the quickest banks to come out and give their feedback on what they see happening in the next couple months, and there's a few of them out there, but CIBC and BMO came out and immediately said that they've forecasted or are changing their forecasts, and most of the major banks at this point right now are starting to jump on the same bandwagon of seeing 3 more rate cuts happen by the end of 2024. So that could mean that we drop rates 1.5%, the overnight drops 1.5% over the last 6 months of 2024, which means an overnight rate of, but which was 5%, goes down all the way to 3.5%. So if you had that prime rate at 7.2, right? Now you're seeing that discount go down, not 6.2, but we're sitting at 5.7%, which, yeah, it may not be enticing when you're looking at prime minus 50, prime minus 70. Okay, now you're sitting at a variable rate of 5%, but you could get a 3-year fixed at 4.7 or 4.6. But think about it. If you're closing on a mortgage in October and your variable rate could nearly match or get very close to matching your fixed rate within that short of a period of time, I think we need to reconsider the plan and the strategy here. Notwithstanding the fact that fixed rates could start declining, lagging behind, but could start declining over the course of the remainder of the year and into next year. Now, speaking of which, I'm looking at a chart here which shows where fixed rates could go for the rest of this year and into next year. And but for no, there's no surprise here, but it's showing that the fixed rate projections right now are set to decline as much as 0.85% in the next 12 to 18 months, but lag behind variable rates by around 2 to 4 months. And again, that's probably the market's catching up. And obviously, the bank's making a decision on how quickly they want to drop their interest rates. But for the sake of conversation, what that says to me is even for the most staunch fixed rate advocate at this point right now, there is value in considering a variable rate to at least put you in a position where a year from now or 2 years from now, you might decide to then lock in or refinance at that lower rate by paying 3 months worth of interest. So strategies change as information changes, and information is changing really quickly. Now, with that being said, the question mark becomes, okay, where are we from a housing perspective, and why, for what reason do we have to believe that housing prices won't drop off a cliff? Well, I'm not here to suggest that some housing prices won't drop. In fact, I think that some will. But I also think that housing activity is going to increase, and it already is increasing despite us being firmly entrenched into some form of a recession right now. So looking at like what's happening from an inflation perspective, just some more notes on that inflation report. Shelter inflation fell to a 17-month low, which is great. That's good news for us, of 5.7%, still high. But obviously, as you know, with Bank of Canada lowering rates, obviously shelter inflation is going to go down as a portion of CPI. And if you break it all apart, we're under 2% right now for inflation if you get rid of shelter inflation. Some say you can't do that, but it is what it is. We start to also see some of the banks slightly adjusting, although they've been holding a little bit steady as they're filling their buckets right now on fixed interest rates. So we're starting to see sub 5% rates on 5-year terms for most of the banks, even advertise at this time right now. And we're starting to see some of the community credit unions advertise even lower rates for high ratio mortgages, which is less than 20% down. Now, looking at where we're at from a bond yield perspective right now, we saw a major dip a few weeks ago. I did a podcast about this, a pretty significant dip based on what happened down in the States. And then we saw things kind of work their way back up over the course of the last few weeks. But the markets are projecting the bond yields to decrease somewhere around 2.5 to 2.65% in the next 4 to 6 months, which would constitute a likely decrease in interest rates around 0.25 to 0.5%, somewhere in that range, which again suggests rates have a ways to go down. So now would be the wrong time to lock into a fixed rate from that reason, among many others. Looking at things from a fixed rate perspective, if someone was going to lock in today, assuming they had a lower prepayment penalty when you consider banks versus non-bank lenders like monoline lenders at this point right now, if they could lock into even, I wouldn't suggest this for a lot of people, but even a locked in 5-year fixed at a non-bank lender that has a lowest potential of a large prepayment penalty could be worth considering. But you really have to put an asterisk in there for that prepayment penalty to project against the future. And I think that's only for the very conservative person where I would consider that as an option. But this is just based on the current market projections is what to do. So back to strategy at this point right now, where if we were to say the end of 2025 is the point that we're most likely to see interest rates at the bottom, then if we see rates come down with the current projection, overnight rate somewhere around 2 to 2.5%, that puts variable rates somewhere in the ballpark of around 3.5 to 4% for most people. Some could be less, some could be a little bit more around that time, which is the perfect opportunity for someone to assess their situation and ask, do they want to continue on that journey and keep things low, or pay the premium, or pay whatever it is that time for a fixed rate in that type of market. And I think a lot more people will start to do that, which is going to benefit people from an interest cost perspective. And over the long term, I think the economy will have an opportunity to see some benefit over the next year and a half as we try to work our way through this recession. So, looking at it from a context perspective of where things are at and what's happening, I mean, we're firmly on the way down the mountain as far as inflation is concerned. The question mark a lot of people then start to ask is, okay, what does this mean again for the real estate market? And what do we see happen here? Now, if you look historically at what's happened when it comes to housing affordability, typically when we start to see the affordability market change, we don't necessarily see the rebound in real estate values across the board, but we're also entering a situation and a timeline where we have less of certain type of properties ever before and more of another type of property, and still we are underbuilding. So from a supply standpoint, there's a lot of reasons to suggest that certain types of real estate hold pretty steady and others maybe don't rebound for a few years. And if you've been following for me for a while, you know that that type of real estate is the single family home. Looking at a chart here of single family home values or single family home construction, basically, if you look at the chart, you've got blue going up, down, up, down, up, down, up, down, and basically moving its way laterally speaking with a slight increase in total units built. And you've got the red line, which is single family homes on the up, 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 down, 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 down for the last 3.5 years in terms of single family homes being built. So we're building tons of condos, tons of rental units. If you talk to any developer right now, they've switched from doing condos to doing purpose made rental units. So people that are going to rent and not even own, which is basically less expensive for them to build and buy and to finance right now. I mean, that's going to have a lot of pressure on the single family home and the cost of land associated with that. And just generally speaking, looking at that type of product going forward. So if you're wondering, well, what type of real estate is going to be the most resilient looking forward? It is exactly that. It's single family homes. It's residential real estate, homes on land in desirable areas. And even despite everything that's going on, and despite the fact that if you have to go to Vancouver to buy a single family home, it's like average price of $1.6 to $1.7 million for a detached home. It doesn't matter at this point. People have built up enough equity over the last 5 years that they can make the move. And because of the scarcity of the actual product itself in these cities, those property values are going to continue to grow, especially as they're not being built and the plots of land keep getting smaller and smaller and smaller, where they become pseudo, basically postage stamps type lots. And even in that case, those types of properties will still be desirable for most people because it is freehold, it is yours, you own it, and you're not in some form of a strata. So I've kind of got off track here in a couple different places, but I think the point of today's conversation, just in reviewing the market, is a reminder of, especially considering the last few podcasts that we've done here, it's a reminder of how quick these things can change and how quickly you need to adapt your strategy and how you have to be open-minded to not the rate, but the strategy associated with the decision that you're making. And yes, obviously the rate is important. It is a factor, but it's like, how are you getting this information? Where are you getting it from? Who's advising you on the information that you have, and are you thinking out of the box, not only from a theological perspective, but are you actually looking at it and looking at, say, for example, an amortization calculator and saying, okay, well, if I was to punch in right now a current variable rate and a current fixed rate on a 25-year amortization, how much money am I saving or losing over the course of the term with one option or the other, conservatively and aggressively? And today, on a conservative approach, if someone was taking out a mortgage of $100,000, comparing a variable versus a fixed 25 years, you're saving at least $1,000 a year minimum on that term, which is based on the assumption that the overnight rate goes down 2% below where we're at today, which is basically what every bank is predicting, some more aggressive than that. So that's where we're at right now. That's what is happening in the current economy. That is where things are going. The question that we have to start asking is, do we continue? Do things move faster with layoffs increasing, with the outlook continuing to become more and more ugly, so to speak? Does this continue all the way up into an election? Do we see things go down lower than that? There's just a lot of information out there. Now, if you've listened to this podcast and you found this information helpful via YouTube, or you want more information around this and you don't feel like you're getting the advice that you should be here, then you can reach out to my team on Instagram, Facebook, YouTube, whatever you'd like. Best way to get a hold of us on Instagram is at Flow Mortgage Co. or myself at The Mortgage Pug, or you can send us an email, info@getflowmortgage.ca, and we'd be happy to help you out to see if we can assess your situation and put you in the best situation. We've got a lot of great podcasts going up towards the end of the year, and I'd love some feedback on what you want to hear more, because we have lots of different ideas and strategies for both educational and informational content. Thanks for watching, and we'll see you on the next one. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.